Welcome to the quarterly press conferences following the quarterly meetings of the Shadow Financial Regulatory Committee. I am George Kaufman, co-chairman of the committee. I'm from Loyola University, Chicago. We have a number of other members of the committee with us today, so let me introduce them. On my right is Bob Eisenbeis. On my left is Ed Kane. On his left is Chester Spatt. In the audience, we have Dick Herring, who's the other co-chairman, and Frank Edwards, you're hiding. Frank Edwards and Peter Kyle. Well, look at either side first, then I go down the middle. So Peter Kyle, Frank Edwards. We have three statements. You should have copies of those statements in front of you. What we'll do is follow the usual procedure of reviewing the statements in 5 or 6 minutes, and then opening up the floor for discussion afterwards. The first statement you should have is 358. It deals with regulating cross-border swap transactions of U.S. banking affiliates. And Edward Kane is going to talk about that one. 359 deals with the executive compensation, clawbacks, and accounting restatements. And Chester Spatt is going to discuss that one. And our last one is 360, strengthening stress tests. And Bob Eisenbeis is going to discuss that one. So our first lead-off speaker is Ed Kane. Ed?
Thank you, George, and good afternoon, everyone. The Dodd-Frank Act turned the U.S. regulatory world upside down, and all three of our statements this afternoon deal with various elements of implementing provisions of the Dodd-Frank Act. My statement concerns with the derivative provisions, and of course the purpose of them is to reduce the likelihood that derivatives market participants might require another taxpayer bailout in the United States, and the issue being to preserve financial stability by setting some rules for these markets that will promote that. Now, currently, non-U.S. affiliates, by which I mean an affiliate of a U.S. banking corporation that is operating in another country and chartered in another country, have found a way to escape U.S. regulatory oversight of their swaps transactions. And to close this loophole, the Shadow Committee thinks it's very important that the Commodity Futures Trading Commission exercise authority over these non-U.S. derivative affiliates of major U.S. banking organizations by registering them as swap dealers and major swap participants, and to go on to set appropriate capital and margin requirements on the derivatives activity. And the CFTC does have an advance notice of a proposed rule to that effect. Anyway, on December 13th, 2012, the CFTC and the Securities and Exchange Commission published a joint rule that both defined and distinguished between a swap and a securities-based swap. Now, the words themselves don't seem like you could make such a distinction. So, but it is in the Dodd-Frank Act in that the SEC has authority over security-based swaps, and everything that isn't a security-based swap is a swap. So, the publication of these final rules triggered deadlines for complying with many regulations that the CFTC had promulgated and started the SEC sequence for finalizing its own derivative rules. And swaps dealers and major swap participants needed to register with the CFTC by February 11, 2013. And then there was a phase-in for clearing interest rate swaps and credit default swaps that was scheduled to begin at a series of 3 compliance dates. So as these were reached, these rules came into effect. Now, why does it matter to be a registered swaps dealer? Well, they have to comply with a number of new rules governing swaps reporting and record keeping. That is, if they're subject to the CFTC authority. And there's conflicts of interest policies, external business conduct standards, and then to enhance transparency, the conduct standards require, among other things, that the dealer receive and report particular information and representations from its non-dealer counterparty. So the idea is that the U.S. authorities would get a flow of very useful information about possible threats to financial stability developing in these markets. Now, for swaps transactions between foreign entities and firms with what's called a U.S. nexus, that's how they define, how regulators define these foreign entities that might be regulated in the U.S. The Dodd-Frank Act divides regulatory authority over financial institutions and swap transactions in confusedly overlapping ways among the federal banking regulators, which I hope I don't have to enunciate for this group as to who they are. And their rules focus on the behavior of banking institutions, and then the SEC and CFTC gets a partly parallel authority over markets, over maintaining the integrity of the particular markets under their jurisdiction. So the overarching responsibility of all 6 or 7 of these agencies is to address risks to U.S. persons and threats to U.S. financial and economic stability, irrespective of wherever these threats emanate, that is, whether within the U.S. or outside the U.S. So in confronting the risks that emanate from cross-border activity, U.S. authorities have to balance their own U.S. concerns with those of foreign regulators. For this reason, they've actually sought, wherever possible, to avoid conflicting or duplicative requirements. And as a framework for achieving this end, U.S. authorities have enunciated a policy which allows a foreign regulator's rules and enforcement procedures to substitute for direct U.S. supervision once, and this is important, once U.S. officials have explicitly declared that the foreign regime is comparable to U.S. rules in the objectives it achieves, not just espouses. But when it comes to uncleared swaps transactions, which were virtually all swaps actions before the Dodd-Frank Act, so far no foreign country has finalized its rules, and only Japan has offered a detailed proposal. So obviously this renders the policy of substituted compliance impossible to implement for swap transactions. You can't say that a non-existent regime, or an undefined regime, if you like, establishes the objectives of the U.S. regulation. So within the swaps space, jurisdictional issues exist within the U.S. as well. And the Dodd-Frank Act requires individual regulatory agencies to set rules for whatever institutions or markets lie within their jurisdiction, their overlapping jurisdictions. So rules that prudential banking regulators have set for foreign subsidiaries of U.S. banks and bank holding companies that act as swaps dealers or major swap participants focus on defining a U.S. nexus, which is what makes them regulated in the U.S. or regulatable in the U.S., by their effective domiciles, the extent of parental ownership, and the existence of language, just language, establishing an explicit parental guarantee for the swaps transactions. So now I'd like you to turn your attention to the graph that's attached to this, and it's very important that it's in color, or it wouldn't make any sense at all. But as this graph illustrates, the definition has allowed a large portion of swaps trading by foreign domiciled swaps dealers and other subsidiaries of major U.S. banking organizations to move their operations outside the span of both direct U.S. prudential supervision and the substituted compliance framework. I mean, the substituted compliance framework is not operational for these swaps, but the business has moved abroad. I want you to look at these graphs. The coding of them is very important and in small print. The blue one, the blue line, is of things that are domiciled in Europe to other things that are domiciled in Europe. The brown is the European, one European counterparty is linking with a U.S. counterparty, and the green is U.S. to U.S. Now notice, just in advance of the implementation of the requirement from under the CFTC that you have swap execution facilities handle these deals, that there's a surge of European to European deals and a collapse of European to U.S. and U.S. to U.S. That basically these deals are still being booked, that until this law went into effect, or this rule went into effect, were being booked in the U.S. by people employed in the U.S., and now they're being booked abroad. So how does this happen? Well, it's been accomplished by eliminating explicit parental guarantees from the language, merely from the language of the swaps deal. So the parent's guarantee is not in these documents anymore. But if the financial crisis, and actually all the financial crises have taught us anything, is that the parents have a very strong reputational reason for making sure that their subs don't default on people. So these parental guarantees, implicit parental guarantees of subsidiary corporations, for instance, in the 2007 and 2008 of special purpose investment vehicles, proved as virtually as strong as explicit ones. It's a distinction without much of a difference in the practical world. And so that's why the Shadow Financial Regulatory Committee recommends that U.S. financial regulators directly supervise the foreign subs of these major U.S. banking organizations that are taking the place of their activity that was done with U.S.-based dealers and major swap participants.
Thank you, Ed. Our second speaker on Statement 359 is Chester Spatt. Chester?
Thank you, George. It's a great pleasure to be here today. I'm going to be presenting our statement on executive compensation clawbacks and accounting restatements. In early July, the SEC released a proposal for public comment to implement one of a number of Dodd-Frank provisions related to executive compensation, and in particular, this provision requires the listing exchanges such as the New York Stock Exchange and the NASDAQ to impose rules for the clawback of compensation to key executives when the stated earnings are subsequently reduced by an accounting restatement. And these key executives include officers under Section 16 of the Exchange Act, such as the company's president, principal financial and accounting officers, vice presidents in charge of the various business units and activities, as well as those who are performing policy-making functions for the firm. Now, the SEC's proposed rulemaking, the proposal was set up on a no-fault basis, so that the required clawback would result whether or not the executive had any role in the underlying accounting restatement. Now, the no-fault provision itself has a number of effects. On the one hand, this type of provision prevents the executive from gaining unenriched enrichment just because there was accounting error. On the other hand, the clawback penalizes the executive by reducing his compensation due to actions for which he might not have had any impact. And how one wants to handle this issue is really, I think, not so clear cut. Certainly if the executive was culpable in creating the accounting misstatement, then he should definitely not benefit from it. But otherwise, this issue is just not very clear cut. Under a no-fault standard, the regulator or the auditing firm, or the board for that matter, doesn't need to establish the culpability of the executive for actions that led to the restatement in order to invoke the clawback. Indeed, this is part of a broader phenomena in which regulators don't seem to be very interested in establishing individual responsibility for securities law violations, which would seem like a very important issue. Because the proposal targets specified groups of managers, these very senior executives that I outlined a few minutes ago, there's not a direct link as to whether this executive might have been in a position to have prevented the accounting misstatement. And so obviously the provision claws back compensation from some managers who were not responsible for the misstatement, while in fact failing to penalize those who, in many cases, were responsible if they weren't in this specified list. Indeed, the no-fault provision potentially leads to a need to provide higher compensation to exactly the executives who are on the list, because they're the ones whose compensation would be subject to these penalties. And this is something that I think the rulemaking proposal is not envisioning. There are other adverse effects as well with respect to the form of compensation. I think the SEC seems to believe that the form of compensation is simply dropped in from heaven and it's fixed. But that's not how compensation arrangements work. Compensation arrangements reflect the underlying nature of regulation. And so, in particular, in an instance like this, you would expect that companies would alter the form of compensation. Potentially that they would change the structure of compensation by encouraging companies to adopt less transparent compensation practices, in particular, compensation practices that are not directly based upon accounting data, perhaps are more discretionary, and those, of course, would not then be subject to this type of clawback provision. So, in effect, the proposal provides an incentive for public firms to shift to discretionary bonuses. In the extreme, a company might redesign its compensation structure so it doesn't depend upon accounting data at all. Given the potential distortions that I've outlined, the clawback proposal would seem to have a variety of dysfunctional consequences. Frankly, it's unclear that the form of compensation should be mandated by regulators. Now, if regulators were going to mandate the form of compensation, and again, I want to be clear that our statement is not advocating that the regulators do so, a more robust approach to optimal compensation than a clawback requirement would be to focus upon adequate long-term incentives by tying compensation to the long-term success of the firm. For example, by perhaps requiring a certain component of compensation be deferred and perhaps invested in restricted stock, rather than micromanaging the specific aspects of the compensation structure as illustrated by a clawback position. Finally, I think it's also important to note that in a whole variety of ways, this only being the most recent example, the Dodd-Frank Act has focused extensively on executive compensation issues. Earlier this summer, the SEC adopted a pay ratio provision, which the staff analysis suggested would at least at the proposal stage, would have no economic benefits. The Shadow Committee finds itself wondering about the extent to which the generation of these types of rulemaking have perhaps been captured by political agendas unrelated to systemic risk, which was what the Dodd-Frank Act was supposed to be all about.
Thank you, Chester. Our third and last statement is on strengthening stress test, and Bob Eisenbeis will discuss that.
Thank you, George. Is this on? Okay. Oh, there we go. This is the third of three statements that deal with elements of Dodd-Frank. Unlike the others, which get into the weeds of the technicalities of the provisions, we focus on the stress test issues on sort of a higher level conceptual look at the stress test that the Dodd-Frank mandates that the Federal Reserve impose on large bank holding companies with assets of more than $50 billion. One of the things that's pretty obvious if you look at the data on, and particularly the results of the stress test, is that, in fact, bank capital has been improved, the capital adequacy has been increased. That's all positive. And in this statement, we really take a look at and say, what else could be done to enhance the effectiveness of the stress tests in a way that would build upon the framework that's already been put in place? We now have 3 years' worth of experience with the stress tests, and that's part of something called the Comprehensive Capital Analysis and Review, or CCAR, which focuses specifically on the capital policies as distinct from the stress tests themselves. The stress tests are essentially, the way they're structured now, are basically a top-down but a very complex set of processes involved. And what I want to sort of give a brief overview of what happens. The main focus of the stress test really is on 3 scenarios that the Federal Reserve staff have put together that involve some 28 different variables that they impose that look at various aspects of economic performance. The stress tests start with a base scenario, an adverse scenario, in which the U.S. experiences a mild recession, and a severely adverse scenario, where banks not only experience a domestic recession, but also, not unlike our situation right now, problems in the global economy and a shock to asset prices as well. The idea here is to provide the Fed with a range of information about the various conditions in institutions that may accompany a recession and enable it better to identify the kinds of vulnerability that the institutions they're focusing on may be experiencing. Now, in addition to this, the institutions themselves also must do their own stress testing at least twice a year, and they incorporate not only the scenarios that the Federal Reserve has put together, but also attempt to identify, by looking in detail at their own institution, the kind of stresses that they themselves may be unique to that particular institution. They also engage in a self-identification of scenarios, in addition to the ones that the Federal Reserve has proposed, that might significantly impact their institutions. There's a common problem here when you start to specify some of these broad-based scenarios, particularly ones where you talk about a change in GDP or an unemployment. How does that filter back through and affect actually the composition and the risk profile of an individual institution? That requires a lot of detailed analysis and thinking about what the structure would be like. Now, the CCAR clearly has enabled institutions to be a bit more forward-looking as they are evaluating the institution, but we think there's ways that can be done to improve the whole process in sort of 3 different dimensions. One, we would like to see an elevation of the self-identified stress tests that the institutions have evolved to highlight not only for individual institutions, but perhaps to identify additional scenarios to supplement the ones that the Federal Reserve had from a top-down approach imposed upon the institutions. Those self-identified scenarios could then be aggregated across financial institutions to identify whether certain scenarios perhaps would be more beneficial to focus on than the ones that the Federal Reserve had initially started with. Secondly, I think there's an opportunity to take and interject more into the process the traditional inspections and examinations that the Federal Reserve is engaged in. And finally, market data can also be used and should be used. The banks, as already mentioned, produce their own stress tests. We know that the FDIC has researchers who have identified ways of aggregating risks using Markov chain simulations as a way of enhancing the identification of the stresses that may be evolving within the financial institution. And we know, too, that researchers have now successfully identified the ability of market information and market prices to help identify institutions that are beginning to experience financial difficulties. So we think that by elevating these other components of the process and the information already being generated, it'd be possible to enhance and improve the overall process of stressing the institutions in a more forward-looking way. This can be done using existing information without imposing additional burdens on the financial institutions themselves.
Thank you very much, Bob. It's now time for the audience to participate, ask questions. I'd appreciate it if you would identify yourself, your affiliation, and address your question to one of the three presenters, or one of the four of us on the platform here, and or of the three members in the audience. First one, let's go right over here. There's a microphone being circulated.
Thanks for your presentation. I think for the financial institution, or actually for every agencies, I just wonder, how do you take care of their accountability, and how reliability of their data for you to analysis, and how do you rely on their self-evaluation or their stress test?
Well, that's a good question. The data within the financial institute, obviously market data is pretty well observed, and it is what it is. The financial institutions within the regulatory process also has a way of evaluating the examiners have a way of evaluating the institution. We have accounting rules that determine the responsibility for improving the information being disclosed to the public. So I don't think that that's a really big problem in the whole process. I think it's more how the data are put together and utilized rather than the quality of the data themselves, if I've understood your question properly. Dick, you wanted to add something to that?
I just wanted to, I'm sorry. I wanted to add one detail. It's a very different world than before the crisis, when institutions were kind of modeling their own risk weights and saying, this is what it is. The Fed is now very, very careful to check and is insisting on very granular data. They make their own estimate of what these data imply about the future capital adequacy of the firm. And they also check the process through which firms generate their own scenarios to make sure that the firm's identification of its risks corresponds to other objective indicators. So there is much more attention to the integrity of data and the integrity of the process than we had before the crisis. So I think they have paid attention to that concern and done about as much as you could expect to correct it.
Could I just add one point, that obviously if you're dealing with a fraud, outright fraud, you're going to have cover-ups, and to the extent there's other kinds of misrepresentations, that's always a challenge for the examiner. An examiner, I've never heard an examiner say that it's a friendly thing to come into an institution, that there's a cringe factor that they meet at the door.
Next question back there. The microphone is coming to you.
Hi, my name's Elaine Middleman. I'm a proud graduate of Carnegie Mellon. Now the Tepper School, was GSIA. This is for Professor Spat. In terms of the accounting misstatements, would this clawback provide an incentive to not report the accounting misstatements in the first place? And also, what kind of orders of magnitude are we talking about here in terms of restatements?
So the restatements could be of various orders of magnitude. Sometimes the restatements are substantial, of course, because for the auditing firm to come in and demand a restatement, there is a materiality threshold, of course, that has to be satisfied. I'm sorry. What was the other facet of your question, Elaine?
Need my mic back. In terms of the accounting misstatements, the way I read this, it doesn't say how they came about in the first place.
Oh.
So would there be an incentive for, even if these people are or are not responsible themselves for the error, somehow that it wouldn't be reported in the first place?
Well, a couple of observations about that. So I think in many instances, the executives already would be pushing back against a restatement relative to the auditing firm. If anything, this at the margin perhaps would heighten the incentive to do so. I think that's perhaps less of a fundamental problem here because of the nature of the incentive of the auditors and the like than the incentives associated with changing the form of compensation. Though I think that's perhaps a more serious issue. And and clearly the auditors, and often the auditors have their own perspective with respect to a misstatement. Auditors and regulators, often management obviously has a somewhat different perspective.
Over here,
Give him a workout.
Hello, good morning, everybody, or good afternoon. Since there are not many people, and I'll just not let this opportunity miss. I have not much knowledge about these things, but I think as a responsible citizen, I think I could fall into that category, whether it's for the business investors or, I think if we look at the world in terms of materialistic value, and now it's going more and more towards that direction. And I know I'm a Tibetan, and we have great leaders like Dalai Lama, but very few who's educating and trying his best before he's dying, before he's leaving this world or whatever. And he's in his mid-70s or 80, almost 80, I think. So whatever. With that said, I know you guys have the most, one of the most prestigious opportunity to work in an institution like American Enterprise Institute, and I'm from India. So for me, and I'm almost like retiring age now, and so I thought I will share this thoughts out, or at least one of us in this one, if they pick up and do some positive changes, which are so easy. That it will be so fruitful, I think, for blurting out and trying my best to speak my head out. And thank God there are not many people here. So my question is, I know there are many other think tanks in DC or in the United States, but when we look at the website and all these things, or the places that I do get to attend, I do travel quite a bit, and I should mention that DC is, we still have the best goodies here. And no matter what means we are using, I'll throw in a lot of data now. Please consider it as very valuable. And the ones who want to write a book or just plainly contribute before in this short life, I hope it will be very, very useful. So just to mention that, I think that they are doing whatever you guys are doing in almost every nook and corner. And that's my greatest fear. I know when my country, we have a very small population, and our country's, disputed and this and that, and who cares about that? By now, it's all biotechnology, and I'm like much at ease. But what I mean is other countries like China, they talk about China and United States. Absolutely, United States is the greatest. No matter what the criticism and what the drawbacks we have, what limitations and what shameful things we do ourselves over here, but still we must tell ourselves each time we go to bed that you guys are the greatest, and we guys are the greatest witnesses, to the very least, And so with those kind of background in the head, do you have or if it's a secret, why not? Why not make it a secret? That do you guys have methods or, strategies where, just in the old days, they say first class, second class, this high class, low class. In India, we have this caste system and all that. It's so ugly, and in this country, it's such a blessing to be moving around so freely and happily. But on the other hand, because
do we have a question here now?
Yes, you guys are giving us all these beautiful tools to make the life so modern, and that do they have systems to at least safeguard, let's say in United States, the most decent families, the most decent elderly group, that no matter, even if they have to write down 100 times by hand, do they have those systems, okay, to safeguard the so flexible, technological age? where they can, swipe it
Well, we'll stop at this point and
Yes.
answer the question up to this point.
Okay,
Bob,
sir.
you want-
All right, thank you. So please do devise some, I'm sure you guys have. If you don't have, it's high time we do that. It's possible. Otherwise, it's going to be very ugly. Okay, thank you, Bob.
Well, you've raised a number of questions, partly related, I think, to last year. You were talking about the security of transactions as it relates to the financial system as a whole, which is one area that we're all concerned about. And in fact, that's an issue that we're going to consider potentially at our next meeting about how one best protects the integrity of the financial system in a world where you have the evolving technology that you're talking about. I think that's we've heard a lot about data breaches and so on, and the need to deal and address that issue, I think, is very important, and that's one of the elements that we're going to have on the table of the next meeting.
If I could step in, another thing that I heard was your concern about materialistic values and that someone like the Dalai Lama would have a very different culture than we have in the United States. I was a little disturbed by your praise of think tanks of D.C. I have never met a think tank that isn't promoting a materialistic value.
Yes. Microphone.
Thank you. Wayne Abernathy, American Bankers Association. Question for Dr. Eisenbeis about the stress tests. I think one of the problems we have seen with the stress tests is they're prone to groupthink. They have sort of the same way of looking at the world with the folks inside the Federal Reserve, and I think your ideas perhaps are a way to try to get at that groupthink problem. I'm wondering if they're enough, though. I think if we'd done stress tests before the housing bubble exploded, groupthink would have said there's no problem here. Similarly, I'm not aware of very many people that were predicting the collapse of oil prices, and yet that's an important stress factor. Are there other ways or things that need to be done to get at this groupthink problem in setting up a stress test?
Well, I think that was partly what was behind our consideration of this particular issue, that if, in fact, you start with just the top-down approach where you're only worried about one or two or three scenarios, if you don't have those scenarios right, everybody is going to be focused on how do you protect yourself against just those scenarios. And what we understand that's going on is that the institutions are also now beginning for the first time, really, to think about what their own exposures are in a more forward-looking way. We know that in some cases, institutions now have war rooms that they've put together to try to worry about forward-looking kinds of risks. And I think if we had had a process in place where institutions who were heavily, for example, concentrated in real estate, and we had said, what happens if you have a really adverse scenario to the point where it would cause you to fail? How severe would that have to be? How would it be distributed across the country? Is that a realistic concern? And if you identify and ask these institutions what their exposures are, and then you start to aggregate across different institutions in different parts of the country to try to figure out how important those risks are, I think that's a way of trying to avoid the groupthink that you're talking about. So that's partly what was behind our whole idea in this particular statement.
Over here. Okay, Chester.
I think Wayne's question is an interesting and an important one. What one aspect of the stress test, of the whole stress test structure, which I think is sort of very much in this groupthink spirit, and which I think is somewhat awkward, is that there's a focus upon a very limited set of scenarios. Besides the baseline scenario, there's just the adverse scenario and a substantially adverse scenario, and that's it. And so in the selection of those scenarios, for example, it seems to me that groupthink is a fundamental problem.
Yeah, I wanted to say that, one of the problems with macroeconomics is it just pushes aside all the regional elements, all the class elements of the damage and risks to which we all face. So I think the idea of the bottom-up approach of trying to get institutions to say, what in our region should we be worrying about, would be very, very helpful. Because as I read history, people almost never are identifying the thing that knocks the economy into crisis. That it just, like, certainly in the case of real estate, everyone just was really so blasé about get your house now before the price goes up beyond what you can afford.
I might note that Bob Eisenbeis and I are working on a paper, someday we'll finish it probably, that looks at the different causes of the crises year after year, and they're very different. The current one is very different from the one in the 80s, which was very different from the one in the 30s, which was very different from the one in the teens. And so this is an attempt to get at the unique characteristics and not sweep them all under the carpet the same way. There's a question right over here.
Yeah, Thomas Ford, I'm an economist. I want to follow up on what Wayne had to say, because the question, like you said, you say that each one has its unique problems, but yet often the policies that were implemented from the previous one actually give indication what caused the next one to happen. So there is a lot of commonality. And then the further issue, I've done a lot with banks. And when I go into a bank and try to help them, like with a system, what isn't coming back is, are we just creating bureaucratic checklists, or are we actually instituting systems and means that's actually helping them reduce their risk? Or is it just creating extra overhead?
I think there's a couple points there. George mentioned the paper. One of the things that became pretty clear as we were doing this research was that oftentimes the response to the last crisis put in place a series of regulations and constraints and incentives that generated and played an important role in the subsequent crisis, and that's a big issue, and that's what we're concerned about in case of Dodd-Frank and how things may evolve in the response. We've talked about unintended consequences and unintended incentives, and I think that's a big theme that we've identified, and I think it's a very relevant and cogent concern.
Yeah, this is another very good question. I think the commonality is the collapse of asset prices in the booming sectors. So you know that's really something to focus on. What are the booming sectors? They're very likely to overshoot, and so there should always be special attention paid to those. I mean, I think that's a lesson of history that we can all learn. And as for the checklist approach, it's very hard to change the culture of a regulatory agency or even of a regulatory scheme. The central banks around the world think of themselves as rescuers. The economy gets in trouble and they rescue people, and in particular they rescue banks. And what we have to do is to break into that a bit, to say that we don't rescue everybody. Our hospitals and our ambulances don't rescue everybody. Some people are too far gone to get that treatment, but we have not put that into the mindset of it.
Yeah, one of the things, think about the statement that Ed was just talking about in terms of the incentives that were put in place because of regulations and change in regulations to shift activities abroad. That's exactly the kind of unintended consequence, and people are pretending that the liabilities, the reputational risk, isn't there. And that's the kind of thing we have to be really concerned about. And that's a very clear example and to your very point.
Chester?
Yeah. So I'd like to follow up on a couple of points. So on the checklist issue, I think this is a very important issue that you're raising. And I thought one of the most dramatic examples of this occurred in the aftermath of Sarbanes-Oxley. One of the key and most controversial provisions in Sarbanes-Oxley was the Section 404, which required audits for public companies of material and required the auditing firm to identify material weaknesses in internal controls. And lots of complaints, of course, about the cost of producing this, but what was basically the product? Typically, in many cases, the product was a list. And what was the scale of the list? In some cases, the list was literally thousands or tens of thousands of material weaknesses and internal controls that were being identified. So you had situations where these firms were paying big fees. They were getting these lists. Now, some of this may have been informative. Over time, some of this kind of gradually sort of sorted itself out. But there raises questions about how can a company have, in fact, so many, almost by definition, how can there be so many material control points? And what does it mean to put this on a list? On the point of unintended consequences, one of the things that was very, very striking to me in the period of time when I was at the SEC was that the legal staff liked to talk about various unintended consequences associated with different rulemakings. But the way they talked about it, I thought, was maybe a little bit disingenuous, because they would talk about unintended consequences from the point of view of these weren't the things that the rulemaking was supposed to be getting at, and therefore it was if they didn't need to have ownership of these consequences. My view is that what the consequences of a rulemaking are all the consequences, both the intended ones and the unintended ones. And to simply classify consequences as unintended, that doesn't take away the ownership associated with the costs. And indeed, in some cases, these unintended consequences were even described in the rulemaking proposal itself. So certainly at a minimum, it says that the unintended doesn't mean unanticipated, because often the rulemaking proposals actually did articulate these things.
Well, so many times, both in tax law and in regulation, people just push through what they're trying to do without even going through the first round of what would be the obvious circumventions. And I think that's really very much the case with this de-guaranteeing of the transactions of foreign subs. Immediately people said, how can you do this? This is what they will do. And they did it. And they started doing it the day after they'd gotten it into the rules.
Question in the back there? Yes. Way in back.
Thank you. Benjamin Kay, U.S. Treasury. So I have a question for Professor Spatt. Is that right? In partnerships, architecture, law, they're in decline as an organizational form of incorporation, but the idea of a bunch of people in a similar profession watching each other and being financially responsible for each other's mistakes is actually a fairly long-established form of industrial organization. And it sometimes works, it sometimes doesn't, but it doesn't seem that innovative. And I was wondering if you see important structural differences between these clawbacks and that form of organization, and if there's anything from the partnership model that we would, in fact, want to copy and bring into the corporate boardroom.
Well, I think that's a very good question. It actually relates to some of our sort of internal discussion about some of these issues. We actually, in some of our discussion, talked a little bit about the old compensation model at Goldman Sachs, when Goldman Sachs, in fact, was organized as a partnership, and what were some of the efficient aspects of that, which, by the way, involved the partners having tremendous amounts at risk, like most of their wealth being at risk. So I think your question is a very good one and a very interesting one. I think in part that's why we pointed toward the end of the statement to the issue of perhaps if one was going to go the route of mandating compensation restrictions, and we're not sure one necessarily should do that, but But if one is going to do that, perhaps one should take a bit of a broader type of perspective and not focus so narrowly upon clawbacks or other very specific types of provisions, but focus instead upon some minimum level of in deferred compensation, restricted stock, kind of tied back to the business. And in our discussions, we didn't necessarily specifically have the partnership model in mind with respect to that, but certainly that would be very relevant in a partnership setting, and certainly the way a lot of the partnerships work is at least until your exit, and sometimes even beyond your exit, you're bound up in the economics of the partnership. And so I think your question is kind of to some extent in the spirit of particularly the next to last paragraph of our write-up.
I'd like to add a little bit to this. If you think about historically, there are four main groups of firms and organizations that started out as partnerships: the rating agencies, the accounting firms, investment banks, and law firms. And three of those four groups, when they began to form and switch to the corporate form of organization, in one way or another, began to get into trouble because they lost some of the incentives that were inherent in the monitoring that went on within the partnership form. I found it interesting, if you read Liar's Poker, Henry Kaufman said one of the reasons he left Salomon Brothers when they formed the corporate form was that they lost a lot of the internal monitoring governance. And so I think there's room to do a lot more thinking about, from particularly a finance perspective, in terms of how we can capture some of the monitoring and benefits of the partnership form. From a finance perspective, the theory was always, well, if you can align the interests of managers with shareholders, all the problems are solved. And obviously that didn't turn out to work out quite as we as finance people thought.
You hit a hot button, obviously. Well, if Ed has one more comment, then we'll give it back to the audience, and then we may come back here. Ed?
Well, I think the real issue is deferred compensation. I mean, the partnership model gives you deferred compensation. I've argued for some years now for deferred compensation for central bankers and financial regulators, that you'd put a fund in there, and if they didn't have a crisis 5 years after they left, they could get at that fund. And I think it would really improve their incentives. That we had a guy at the FDIC who left as a member of the board and came back 3 years later as the chairman. He said as he was leaving, he had all these cases. He said, I don't have to worry about these. And when he came back, these were on the top of his pile.
And some of you may be here for one of the first times. You don't know how this committee works. We meet for 2 days before the press conference, all day Sunday, and then Monday up to the press conference, so it's really a day and a half. And we discuss these issues at great length, sometimes calmly, sometimes not so calmly. We cut down from maybe 4 or 5 that were on a preliminary agenda to the 3 that we want to talk about. And so we give quite a bit of thought to these issues. There was a question over here.
Well, thank you all. I've been a student for a long time of the professors and a fan of Cumberland for some time as well, and I appreciate everybody's work. Your ideas were, I'm Dino Falaschetti from House Financial Services Committee. Your ideas were introduced as trying to get away from top down, and I think there's a great question from our friend at Treasury on a more bottom-up approach, and so maybe this will complement that question. And that is, even the ideas that I'm hearing sound like they're top down. That is to expand SEC oversight, let's say. If counterparties think they're going to be on the wrong end of a deal, you'd hope that they would be monitoring that transaction. And so my question is, I know you guys know this, but I also appreciate that you have some maybe practical concerns about going all the way forward to market competition as a better regulator on systemic stability, for example. I would think that my stress test should be like top secret trade secret, that this is a source of competitive advantage. I wouldn't want to share this. And so I wonder if you can comment on what are the practical difficulties to us getting to a more market as regulator rather than top down as regulator.
Want to start?
Sure. So I think one practical difficulty has to do with issues of seeing the broader system and issues of perspective and expertise and potential externalities between these financial institutions. The systemic aspects are probably ones that are ones inherently by their very nature that individual institutions are not going to internalize. That's to some extent, what's almost inherent in the nature of system risk. So I think on this issue, maybe more so than almost any other regulatory issue, some degree of oversight and some degree of pushing kind of along is important. I do think, while I have mixed views about the specifics of the stress tests, I do think it's been healthy that the financial institutions have really been pushed relatively hard to understand more fully what are the nature of the risks that they're bearing and confronting and to some extent imposing on the rest of the system. But I also agree there are a lot of challenges. But I think I'm not sure we can kind of this is the systemic aspects because of the inherent externality. These are, I think, harder than most to see that we could fully move to a market system.
I've been thinking about this question throughout my career, and I've come to the idea that the way to think about traffic in financial markets is to compare it to traffic on the streets. Now, if we didn't have rules and people enforcing them, just think what traffic would be like. There'd be chaos. And even if some other ones reflect safety. When I'm driving along on a highway and I'm in a hurry, I'd like to go 80, 85, 90. I think I can do that safely, but I can't. I mean, literally, this causes a lot of problems for other people. So we have people that are responsible now, so for the safety of others, and that's where the competition is seeking, as this lady over here said, materialistic ends, the best of the people that are running these financial cars. And we do have to have some coordination and some safety rules. So the issue is then how to balance all of this, and how to prevent the regulatory system from being corrupted, which is the real problem in the United States, that we make rules to help one group at the expense of others.
I think another principle that I've seen at work is the importance of transparency. I don't think keeping things secret is necessarily the way to go, and I'll give you an example of that. Back, and many of you probably don't realize this, back up until about 1971, it was actually illegal to release income information on banks. And part of the reason for that, and I sat at meetings at the FDIC when I worked there, part of the reason for that was the concern about the safety of the deposit insurance fund and the institution versus the interests of the depositor. And I remember examiners saying, well, if we release this information, investors won't put money into this institution. Well, we've come a long way from that attitude, and I think more transparency and more revealing actually generates a more efficient market, because if you don't have good information, you don't know what you're buying and what you're investing in, you're going to make mistakes and you're going to get hurt.
Was a question back there? Do we have any other questions? Yes, over here.
I just wanted to follow up a couple things. I'm an attorney, so I'm not in a big law firm, but I think the partnership model may not be the best because a lot of the law firms are either going bankrupt or there's a criminal trial going on right now in New York. So, I mean, it may work, it may be a good model, but I don't think it necessarily is a good model. And in terms of transparency, I'm definitely in favor of that, but how do you know when the numbers are not being manipulated or, you know, subject to restatement or whatever? I mean, there's so many incentives to not really tell what the numbers are, and it makes, you know, if you rely on those numbers, they're not accurate.
The way I think about this is, think about football. We have rules that define the shape of the field. We have referees who are involved in the process, but they don't hike the ball, they don't run through the line or anything like that, but they do enforce the rules. And I think that's the way we're thinking about some of the roles of regulators, is to enforce the rules. What troubles me is when you end up with the referees owning some of the teams, which is now what happened in the case of the UK and owning the Royal Bank of Scotland. The minute you start to have the referees owning the institutions, like what's happened in the financial crisis in many parts of the world, then you get conflicts of interest and everything else coming into play. So I don't mind having regulators setting the rules of the game and enforcing the rules of the game, but they shouldn't also play.
Well, George Kaufman has for years made the point that there's nothing wrong with firms going bankrupt and exiting an industry. You know, if your industry's overcrowded, you have to let that happen. And if instead you use manipulation of corporate rules to keep them going, who are you helping?
Yeah. With respect to also the partnership model and the partnership model not being a perfect model, I wasn't trying to suggest that it was a perfect model. I was trying to respond, I thought, to a thoughtful question about, you know, what could we take away from that model. And, you know, it is certainly interesting to observe that in a lot of contexts, obviously, as we've been discussing, we really have moved away from the partnership model. You know, obviously Goldman Sachs and maybe most or all the other Wall Street firms basically concluded that they couldn't really finance themselves out of that model, that there was, in effect, they weren't in a good enough position to bear the sort of risks that a global financial services firm needs to bear. You know, so yeah, I mean, I don't think that it's necessarily a perfect model, but I think it is. You know, I think it is worth reflecting on different models and, you know, how one would think about compensation and how it would work in different contexts. But I also see that as in the spirit of our critique on the clawback issue, which seems like it's coming in a very specific way, and that just seems like kind of a little bit of an odd approach.
Well, half of this committee sort of been getting off and saying nothing. Let's give an opportunity for the three members in the audience of the committee to say something if you want to, Dick.
Well, I think this raises a wide number of issues that are going to be a continuing concern. The tensions between having very prescriptive regulations on the one hand and having market forces play a greater role on the other are ever present and are not in any way receding as a result of implementing the various parts of the Dodd-Frank Act.
Hi, if you look at all three of our statements, they're about information. And they're about the information not only that regulators need, but also that policymakers need and members of free society or public investors need to evaluate what's going on. In the case of the stress tests, it's information coming not only top down, but coming from the banks themselves about the risks they face. In the area of executive compensation, we want to preserve incentives for the firms to explain to their investors what their compensation is based on. And in the case of swaps, not only do regulators but also public investors need to know what the potential off-balance sheet risks are of the firms that they invest in. And to understand the importance of this, just think about how this discussion would play out if we were in China or we were in Russia or we were in Brazil, and we were asking for transparency about executive compensation or about swaps positions or about the risks that the banks would face due to financial stress. They're just not anywhere near where we are. So we're essentially trying to take what we think is a reasonably good level of civil society and raise it incrementally.
Yeah, I'd just like to make one overall point, partially in response to the woman who asked the question on partnerships versus corporations. It's a very big question. It's an old question. And really the essence of that question is the alignment of incentives within any organization, right? That's the fundamental issue. And the answer is we all know that, and we've known it for really hundreds of years. And the problem is no one has the perfect model of how to do it, because no matter what legal structure you use, whether it's a corporation, a partnership, anything, those inside the firm often have different interests and therefore conflicts of interest, and that's how you get fraud and other things like that. And we don't really have the answer to this problem. The clawback thing is simply about aligning interest once again. So this is a big, big issue, which we've discussed for a long, long time everywhere, and there are no answers to this. So you do the best you can, and you hope that it's not disastrous. Thank you.
Do we have any more questions? Yes, up here.
For all this fraud, exactly, is there any public website that can really receive a public comments? And the second is, as we know, too big to fail, actually, they are also anywhere, any size, they commit a fraud. And I think we have a Attorney General, we have White House, we have Supreme Court, they have all the black there. That doesn't matter because the minority is minority. Maybe they suffer most. They are victimized most. And so I just wonder, besides those numbers you take, do you really examine the complaints, or do you really examine their communication with citizens or their shareholders? Because they have complained not only disregard, but they are further victimized. They temper their website, they change their personality or even their name, everything possible.
I guess I'm not quite sure how to respond. I don't know of a website, but Pete, you wanted to make an observation? Oh, I thought you said you did.
Chester does.
Oh, Chester does, okay.
Let me try to make one observation. I'm not sure if I fully understand the question, but I thought parts of it perhaps were about our statements, and then parts of it were about the comments to the regulator. So our statements have been typically available on the AEI website and also on the Wharton Financial Institutions website. That's with respect to our statements. But I think in part you're also asking about comments. So the regulators, when they have rulemaking proposals, they put those out for public comment. The comments that are provided to the rulemakers are publicly available on the website of the regulators. I mean, are we sort of generally aware of those comments and feedback? Yes. Do we study those comments in detail? Well, no. I mean, there are only so many hours. There are only so many hours in the day, and that's why the SEC has a staff to study that.
I would say in preparing this deregulatory deregulating issue, I did read the staff summary of the comments that had come out on these rules and thought about them.
Question over here.
Paul Anirban, only if you have time to address the issue of risk weights in order to evaluate the adequacy of capital. And that is, it seems to me, and I'm thinking as I was reading this, that if you're talking about adequacy of capital and there are different kinds of capital, there probably be weights on it. So at the margins, the banks might want to divest of the higher risk capital. Where is it going to? Is it going into the shadow sector, or is there a drop in liquidity for, say, bonds, municipal bonds?
We've had a number of statements that have focused on the problems that we perceive to be with the risk-based capital approach. The risk weights are arbitrary. They don't respond dynamically to changes in the marketplace, which they should. And in fact, this is a case of regulatory interference in the sense that misplaced and mispriced, essentially mispriced risk weights, induce institutions to invest in activities that perhaps they might not otherwise want to do. And we've taken positions that, in fact, you should do away with the risk weights entirely and just worry about the total equity position and capital adequacy in the institution itself without the regulators trying to influence what assets institutions invest in. Classic case of misrepresentation, I think, is in Europe, where essentially all sovereign debt was treated as the same with a low risk weight. Well, we now know that sovereign debt is not all the same. And that's a classic example of what you don't want to have happen. So we've argued you should do away with the risk weights entirely and have a leverage ratio.
Examples here. The other one for the United States, of course, and the rest of the world too, is mortgages and residential mortgages. When we lowered the risk weights are for politicians to direct credit.
I would add, they're also to make capital requirements seem higher than they are. They talk about we're going to have 12% risk-weighted capital. That works out to about 5% capital if you're lucky.
Don't get us started on risk weights. We'll never end.
Quick follow-up, though, but to not have any weight does not then consider the fact that all capital is not equal.
Well, you know, of course all capital isn't equal, but your ability to absorb hits to your assets. The problem with crisis in any firm is the assets lose value and the liabilities become larger than the value of the assets. And the simple capital ratio addresses that. Trying to get into the weeds, this is exactly what we've been trying to say, that having these complicated systems invites regulatory arbitrage. Just
He's talking about what's the definition of capital. That's what he's
Well, that's another way of
I didn't think he was. I thought he was still talking about risk weights.
Well, we've been in favor of more equity rather than less, and equity much more so than debt. The minute you start slicing debt into different components, then you worry about priority and bankruptcy and who can impose losses on who. And that was a problem with Freddie and Fannie, among other things, because they had a lot of subordinated debt and there was a great reluctance to deal with their exposures. I think in the end, I can't think of a single bank that failed because it had too much capital.
Well, I don't want to, because no, I'm not taking an ideological position, but the problem will be then it will reduce profitability because somebody's going to put the benchmark so high that the profitability of banks will go down.
I don't believe that.
Well, the way I put it is, some of the so-called profits of say, the major banks is from the too big to fail subsidy. And the whole idea of a capital requirement and other restrictions is to find a way to corral that subsidy. So I don't care if it reduces their profits. That's the purpose.
Well, if there are no more questions, let me thank you for coming. Remind you, our next quarterly meeting is December 6th and 7th, it is. And I hope to see you all at that time.